I'm Rena here from Sage Investors, and I'm here to do a quick mind map analysis of energy exchange traded funds. This video can also be listened to in podcast format. You can download it also through my website, sageinvestors.ca, or you can go to Apple Podcasts and subscribe to my podcast there, Stock Talk. So, oil prices have been just getting schmucked lately. The whole oil market, energy market, has really taken a bit of a dive in the last few months. Oil prices have fallen. They were up in the mid 70s, and as I'm talking right now, prices are now down near $50. And so with the prices coming down so dramatically, and also the fact that energy stocks have also been coming down, I thought, you know what, this might be a really interesting time to get some more exposure to the whole energy market, to energy stocks, to oil and gas stocks. And right now, given where I'm doing right now, I'm pretty I just don't have as much time right now to devote to analyzing individual oil stocks. So I thought the best way for me to get some quick exposure at a cheap price would be through using exchange traded funds, using ETFs. So what I've done here is, what I did was essentially try to pick out a few ETFs and evaluate them according to a bunch of criteria. And so what I'm going to do here is kind of go through my quick analysis of a couple of ETFs that I've picked out, and try to see if anything stands out and seems worthy of something that I may want to add to my own personal portfolios. Now, the criteria that I use to evaluate them are pretty much similar to for those of you who have taken my How to Invest in ETF online course, you'll know that we go through and I teach people how to evaluate ETFs according to these criteria. And essentially, I'm just going to put those elements into practice by evaluating these set of energy ETFs. So let's just jump right into it. So I picked out three different kinds of ETFs out there. One is the iShares product that's available here in Canada, ticker symbol XEG. And the other one is the US ETF, the Spider S&P 500 Energy ETF, ticker symbol XLE, and then the final one is ticker symbol USO, which is managed by the USO Oil Fund, and it's a little bit different in that sense. So they're three very different type of ETFs. So let's take a look at them, see what we can learn about them, and see if any of them present interesting investing opportunities. So let's start off with the iShares Canadian Energy ETF, ticker symbol XEG. Now, this is a Canadian ETF. It basically tries to track the performance of the. Let's just move that over. Tries to model the performance of the S&P TSX capped energy index. So it's a passively managed fund. It tries to hold the same stocks that are within the index. In terms of costs, the management expense ratio, you might hear that term. They charge the cost associated with the ETF is 0.62%. Which is usually pretty high, for an ETF, and especially a passively managed one. But you'll know, and this is something I get into more depth in my course, that when you start getting into more specialized sector-oriented type ETFs, the costs tend to be a little bit higher than owning a broad-based ETF that would invest in the S&P 500 or something like that. So it's high, but it's within the realm of reasonableness on a comparative basis. In terms of Liquidity. Another thing we want to take a look at with with the ETFs are liquidity, how much they trade, how frequently they trade, because ultimately we want to invest in ETFs that are highly liquid, that have very much more accurate pricing, don't have a lot of volatile swings in pricing. We want stability in terms of how the fund is trading, and so the XEG, in terms of size, it has about a 730 million in assets is invested in it, and on average it trades about 1.3 million shares a day, which is pretty good for a Canadian product, because the Canadian market is not as doesn't the volume trading volumes in the Canadian stock market is not the same. It pales in comparison to the U.S. market or even other markets in Europe and Asia. So 1.3 million is actually a pretty. I was actually quite surprised to see it trade that much. In terms of the makeup of the portfolio, we want to take a look and see how diversified the portfolio is. Is it concentrated into a bunch of stocks, or is it, ultimately we want to invest in a very diversified a portfolio as we can to manage the volatility that can occur within the markets and in the portfolio. So when I took a look at the XEG, I was again surprised to see that almost 48% of the portfolio was concentrated in two stocks. The CNQ, which is Canadian Natural Resources, and Suncor. These two stocks basically make up over half the portfolio. So from that perspective, it's a very concentrated portfolio, and essentially the direction of the ETF is really driven by how these two stocks do. So that's one side of it. The final variable we want to take a look at is the tracking area, which we want to see. Ultimately, we want to invest in ETFs that generate returns that are as close as possible to the index that it's trying to model or mirror. Because if it isn't, that means there's some kind of inefficiencies in how that index is being, or how that ETF is being managed. And to make things really simple, when you have an ETF that has a very lower tracking error, it means that ETF is essentially leaving money on the table. And as investors, we don't want to leave money on the table. As we want to put more money in our pocket and less money on the table for somebody else. So in terms of tracking error, I calculated that the XEG has an 88% tracking error rate, which means for every dollar return, 1% return that the S&P index is generating, it's generating 88% of that. So what that tells me, there's a little bit of leakage going on here in the XEG portfolio. So that's the iShares, the Canadian version of the iShares Energy Select ETF. The second one I want to take a look at here is an American ETF. It's a very common ETF called the Spider S&P 500 Energy ETF, ticker symbol XLE. Essentially what it does is it tries to copy or mirror the behavior of the energy sub-index of the S&P 500. So all the energy stocks that are in the S&P 500, it tries to model the performance of those stocks within the S&P 500. So it's a passively managed portfolio as well. So whatever is in the S&P component, energy component, is what the XLE is going to own. In terms of costs, the XLE is really cheap. It charges 0.13%. In terms of management expense ratio, is 0.13, which is very, very low, especially for a sector-oriented kind of ETF. Pretty low, and obviously because it's so low, it's extremely popular. The fund itself, the ETF itself, has about $15 billion in it, 15 billion with a B. And on average, it trades about 20 million shares a day. So this is an extremely popular an extremely popular ETF, especially I would say most of the volume that comes from this and most of the money that's held inside of this is coming from institutions, from professional traders, hedge funds. They use the XLE to get that quick energy exposure, that oil exposure, if they want to have that within their portfolios. So it's a huge fund. So comparing this to the XEG, it's like apples and oranges from that side of it. When we looked at the portfolio makeup of the XLE, I was expecting it to be a little bit more diverse, but I was really surprised to see that over 50% of the portfolio is also tied up in two stocks, and those two stocks are ExxonMobil and Chevron. So again, a very concentrated portfolio, and the fact that most of the money is invested in two stocks means essentially the nature of where Exxon and Chevron go is going to drive the way this ETF is going to go. In terms of tracking error, I calculated the tracking error for XLE to be about 96%. So it tracks very closely to the S&P 500 energy sub-index side of it. So that's the XLE product. Extremely popular, very popular, very liquid, and very cheap. Now, finally, I thought I'd take a look at another different kind of ETF, and this is run by the USO Oil Fund, ticker symbol USO. This is a little bit different in the sense their mandate is to track the price. Is essentially it doesn't own any stocks. What it tries to do is literally track the price of oil. More specifically, the West Texas intermediate price. So essentially, if the WTI price goes up 5%, then the value of this ETF goes up 5%. So what it does is it doesn't own stocks. It basically, what it goes out and does is it goes out and buys futures contracts on oil. So what's unique about this ETF is that if you didn't want to invest in oil companies, but you just wanted to invest in the physical commodity of oil, the USO can do that, allows you to do that by essentially tracking the price of oil. And it does that by buying futures contracts. And ultimately, if the USO decided to actually let the contracts run, then at some point they would actually take delivery of the oil at the specific prices that they purchase the contracts on. So when we look at the XEG and the XLE, they are invested in oil and gas businesses, while the USO is really invested in oil. And that's kind of the cool thing with ETFs is in some cases, especially with the commodity-based ETFs, is that you can invest in a basket of commodity-based companies, or you can just invest in the actual physical commodity itself. And so the USO gives you that kind of option if you wanted to invest directly into owning oil. So let's take a look at some of the other factors, other data points for it. So it's passively managed in the sense that it essentially just tracks the price of oil, it tracks the price of the WTI. From an expense perspective, it comes in at 0.76%. So it's much more expensive to hold, and I think part of that has to do with the fact that we're talking about a lot of derivative kind of decisions that are being made. There's a little bit more derivatives involved in the management of the portfolio, and that kind of feeds into a higher expense ratio. In terms of liquidity, it on average it trades a lot, and on average they trade about 25 million shares a day. So there's a lot of volume, trading volume that takes place around the USO, just in the same space as the XLE. From that, again, because there's a lot of people out there, institutional investors, pension funds, hedge funds, that are trading, and even just commodities traders will, instead of just going dealing with individual companies and stocks, just want to have a pure exposure to just want to trade on the oil price. The USO is a great way to do that, and so that's why there's a lot of trading volume behind it. And finally, in terms of tracking error, the USO comes in at 99.6%. So it is very, very tight in the sense that the returns through the USO track very, very closely to the returns of the WTI. So it's a very efficient, and that's probably a big reason why it's so popular, is it tracks very closely to the commodity price around it. So those are the three ETFs I took a look at. Now, in terms of next step is just try to figure out, is anything here worth buying, picking up. So, and this is kind of where we now do the comparative analysis of the three and see, which one kind of stands out as a better investment opportunity. So, the fact of the matter is they're all they're passively managed portfolios. If we were to look at it from a cost perspective, the XLE is like hands down the cheapest one out there. Liquidity wise, the XLE again, trades 20 million shares a day, 15 billion in assets. Pretty liquid. Same with the USO at the same time. Again, 25 million shares a day, highly liquid. So much more accurate price discovery you're going to get out of those two ETFs. The XEG, even though it trades quite a bit for a Canadian ETF or a Canadian stock, it pales compared to the US component, US based ETFs. In terms of the portfolio makeup, these one I think really what kind of threw me for a loop was how concentrated these portfolios were, and I think that kind of turned me off in the sense that if over half your portfolio is concentrated in a couple of stocks, that's a bit of a flag in the sense that ultimately the price and the value of that ETF is going to be determined by just a couple of those two stocks essentially. And the fact that you're paying, fees to own this, it's actually cheaper for you to just go and buy those individual stocks instead of owning a whole ton of different risky assets. Why not just buy those two stocks from that side of it? So from a portfolio perspective, makeup perspective, the XEG and the XLE, the fact that they're very concentrated didn't appeal to me. And then finally, when we look at it from a tracking error perspective, the XLE and the USO are much more tighter and seem to be much more efficient portfolios in terms of tracking the performance relative to the indexes that they're modeling against. So at the end of the day, that's kind of the tail of the tape of these three ETFs. So what did I do? So what decision did I make? If I were to make a decision about what I wanted to, would I buy any of these? I think right now I would probably lean toward the XLE, purely because it's the cheapest one out there. It's the cheapest one out there. It's highly liquid, and it has a pretty good tracking area. But the thing I think where what kind of stops me is just this whole concentration side. The fact that these two stocks make up over half the portfolio, that kind of concerns me. And then there's another element too that also would hold me back a little bit, and that's the fact that it's a U.S. based. I'm up here in Canada, so that, I would have to buy it in U.S. dollars. So for me, there's also that other element of currency risk that I have to kind of factor into my tolerance, my comfort level with the currency side of it. So there's that side of it, and then there's also the whole issue of if I don't want this if I just want to own the oil and not incur any of this business risk, because this is essentially what you're paying for, is you're paying for that, incurring that business risk. If I just want to own the commodity itself, then maybe I would lean toward owning the USO and just invest in that portfolio. But again, there's a certain currency risk. Also, for me, there would be a little bit of currency risk. Obviously, for my American friends, that doesn't come into play in here at all. So really what the decision I came up with was, I think there's a lot of overhead here that you kind of have to buy just to own. Really what you're owning is a couple of stocks. And so what the decision I ultimately I think I made was, is I decided I don't think I'm going to buy any of these. Essentially, I decided not to buy any of these, and what I was going to do instead was do a little bit more due diligence on these individual companies and see maybe instead of owning these ETFs, to actually own the individual stocks itself. So that would be my that's the next thing I'm planning to do, is just to do a little bit more of a deep dive into these companies and to see which ones are actually better run, better managed, and offer a better valuation. So it's interesting. This is the first time I've done this type of analysis where I ended up choosing none of them, none of the above. So, and that's kind of interesting, and that's kind of the nature of the game with investing. Sometimes you're going to do a lot of due diligence, and at the end of the day, you come out of it and go, you know what? I thought these were interesting potential investment opportunities, but you know what? Now that I've done this kind of little deep dive here, not so much. And guess what? That happens a lot in investing. So that's been my analysis of some energy ETFs. If you're interested, you can go onto my website, sageinvestors.ca. I've done some other videos and podcasts where I do the similar type of analysis and on individual stocks and also other ETFs. So you can check me out through there. So thanks so much for listening in, for watching in. My name is Amin Reina of Sage Investors, and we'll catch you again another time. Take care. Bye-bye.